All right, welcome guys. Welcome back to class. And into this class, we jump right into the next subtopic, which is weighted average cost of capital (WACC). If you remember in previous classes, we've talked about cost of equity, cost of debt, and right now we want to talk about weighted average cost of capital. Remember, I explained to you that if any business wants to raise capital, it can either be through equity, debt, or both equity and debt. And I told you, remember very clearly that I said if you want to attempt any cost of equity question, and this we have KE. I don't want to start explaining, and this is called WACC. I don't want to start going back to previous explanation. If you watch previous videos, I've explained all of this. So the cost of equity or the minimum required rate of return of equity is called cost of equity, similar to cost of debt, right? And here, and remember I told you that every time you want to attempt any cost of equity question or cost of debt question, only view the question from the point of view of the investor or the bondholder. Are you open now? But in the case of WACC, because it is the company that is combining both equity and debt, view it from the company's perspective. Do you understand that now? So I think that's very important. So I've given you a formula for this. I've given you a formula for all of this as well. But in today's class, we're going to talk about WACC. So what's the formula for calculating WACC? WACC is simply, as I've said, is the combination of these two. That means we have KE and KD, right? So WACC is just the weighted. That's it. Both of these, the weight of these things together, that is E over E plus D, the weight of these two, plus this is cost of debt, right? Or let me just put times debt over E plus D. Just talking about the weight, that is simply cost of equity times equity over E plus D plus debt, cost of debt times debt over E plus D, or you can just put it into brackets. Everything you see the same thing. That is simply the corner. And don't forget, this is very important because debt is tax deductible item. So I think I've explained that to you before. So 1 minus T, the T is tax. So just know the formula. It's pretty simple. Let me just explain the formula so that you can remember again. I said, or we've established that WACC considers both equity and debt, right? So this is the cost of equity. Put it at one hand. The cost of debt, put it on the other hand. So he's talking about the weight of these two, right? So the weight of this and the weight of this. So for the weight of equity, it's going to be under cost of equity, E over the total, E plus D. For debt, it's going to be debt over E plus D. And we then put here, it is tax deductible, that is 1 minus T, because debt is tax deductible, right? I've explained all of that to you in previous classes, so please go and watch previous classes. So today I just want to solve a few questions, then we'll move on. So let's solve a question. All right, guys, are you ready for the first question we're about to solve? So let's get right into it. So the first question is here saying Adeniran PLC currently finances its operation through ordinary shares and loan notes. The company has 2 million loan notes in issue, which are currently quoted at 70 per 100 nominal value, and 8 million ordinary shares that are currently trading at 40 naira per share. Cost of debt is 10%, while the cost of equity is 20%. The company intends to maintain its existing capital structure, and corporate income tax rate is 30%. Yarokoya said, estimate the weighted average cost of capital of Adeniran PLC using market value weight. We know what that is talking about. That is talking about WACC, weighted average cost of capital. So remember what I told you guys about SFM. S in SFM to you means speed. You have to be very, very fast. So in this context, you have to run down to the requirement. The very first thing you're going to do before reading any question or something, run down to the requirement first. And so the ICAN is saying you should find the WACC. Good. So the next question, or the next thing that will come to your mind is, what is WACC, or what is the formula for calculating WACC? So you are going to put down the formula. Let your formula guide you. So when you know the requirements, write out the formula and let your formula guide you. Are you with me now? So what is the formula for WACC? So WACC is equal to cost of equity times equity over E plus D, plus cost of debt times debt over E plus D. Don't forget, this is post-tax, right? Tax deductible, post-tax, right? So now that you have your formulas, SFM, I told you, SFM, yeah, speed, yeah, your facts, yeah, mastery. So strategic financial management to you means speed. The first thing, run out to the requirements first and find out what the requirement is. Two, facts. Now that you have the formula, now that you know the requirements and you've written your formula, the next thing to do is to find out the facts and figures and relevant information to use to get your objective function, which is, of course, to get your answer here. So facts, let's gather our facts and impute this variable. So what is A, for example? What is cost of equity? We were given in the question, right? Amazing. Sometimes you won't be given, and that's why I've told you previously how to calculate cost of equity, cost of debt. That one, those ones are simple stuff, right? Then what is the value of equity? What is the value of debt? Then put those values there. So let's find out the values. All right, so the D, which is debt, because the question says that there are two streams that they generate, they finance their operation, and it is through ordinary shares and loan. So this is loan is debt, right? So loan is debt, right? Loan, like Tinubu loan.
Loan subsidy, loan, olóòní of Uniland, Loan Nigeria Limited, Chief of Loan Staff.
Jesus, help me. So yes, so we have, the company has 2 million loan notes. So we have 2 million loan notes, right? Which are currently quoted at what, 70 naira per 100 nominal value. Can you see that now? And for equity, let me just write equity. Equity is where 8 million ordinary shares. 8 million ordinary shares. 8 million shares at 40 naira per share. Can you say that now? Exactly. So please, it's very important. Don't make this mistake, because here it's saying 8 million shares. So this 8 million shares is not the value. This is the total number of the shares at 40 naira per share. That is, one of these 8 million naira share costs 40 naira. That is what they meant by saying 40 naira per share. That is, one share is 40 naira. So to know the total value of this 8 million naira share, what are we going to do? We are going to multiply it. It's simple mathematics, right? So multiply it. What is the answer? 8 million times 40. That is 320 million. But let's quote it. That is 320 million. So 2 million loan notes. That means the loan notes that I have now, I want to generate money, I want to raise money. So I'm going to give them notes and they're going to give me money. Are you with me now? So 2 million loan notes at 70 naira per 100. That will be 70 over 100. 70 over 100. Can you see that now? 70 naira per 100. So then you now multiply it by this 2 million. So this 2 million naira, 2 million loan notes is not the value, it's not the amount in naira, right? So convert it to value, right? So it's going to be 70 over per 70 per 100 is over 100 times 2 million. That is 1.4 million. Can you see that now? So we've gotten our values. What is cost of debt in the question? Cost of debt, cost of debt is 10%. So we have our cost of debt to be equals to 10%, right? What about cost of equity? Cost of equity is what? 20%. 20%. Now we have all our facts and everything. So let's impute them, impute the variables in the formula. So WACC is therefore equal to K. What is K? K is 20% times what is equity? The value of equity 320 over 320 plus 1400 plus what is KD? KD is 10% times bracket. What is D? D is 14 all over 320,000 plus 14. Please don't forget post tax. 1 minus what is tax? 30%. 0.3. So if we, so you are going to do, and please if you want to do this, start from bracket first. Deal with the bracket first. Deal with bracket again. Then you now multiply by each. Multiply by this two. Do you understand? So board mass now. This is mathematics. So you know it already. So yes, 320 plus 14 times 20. So we have 19 points here, 19.91 plus. So let's do this first. 1 minus 0.3 times 10. That is 7. Right? So let's do this one. You can do the denominator first. 320. Okay, we've gotten it already. 320 plus 14. Alright. 14 divided by that answer times 7. That is 0.304. Something like that. 0.304. Right? So put everything together. Plus 19.91. So what do you have? We have 19.94%. Chicken now. Simple. Can you see that? Very, very simple. Very, very simple. Let's go to the next question. So I want us to solve the second question, right? So I just saw this particular question somewhere and I feel it's important we just try to attempt the question. So here, the following data is from the current balance sheet of Smart PLC. So we have all those information. Now says an annual dividend of 20k per share has just been paid. In the past, dividends per share have grown at 10% per year, and this is expected to continue in the future. Annual interest has recently been paid on bonds. Okay, the current market price of shares is 275 kobo, and the bonds are priced at 80 naira. Income tax rate is 30%. Compute the company's weighted average cost of capital. So Yarukwala is saying you should compute WACC. Again, just run down to the requirements. Then write the formula of what you are required to do. So So the second question, WACC, what is the formula? KE over E plus D plus KD post-tax times D over E plus D. Now, the first question to ask now, do we have all this information in the question? Were we given cost of equity? Were we given cost of debt? Let's check. Were we given? From this question, we were not given. Yeah, unlike the previous question. So this time we have to find out what the cost of debt and what the cost of equity is in order to determine our WACC. So what about these variables? Equity value, debt value, do we have it there? I'm not sure we have it, but we can find it. So it's important that you note this, that every time or anytime you are giving balance sheets, please do not use those values, because that is the book value, that is not the market value. And when it comes to valuing equity or debt, you use the current market value, not the historical or the book value. Are you with me now? So we are not going to use the values in the table. We are going to use the market or the current market value. All right. So let's get the cost of equity. Let's get cost of equity. So how are you going to get cost of equity? So based on information we are given information about dividend, right? So that should signal to you that we can use dividend valuation method to determine our cost of equity, right? So, and what is the formula? It is dividend 1 plus G when we have growth over market value X div plus G. That is the formula. So the dividend just paid. How much is the dividend just paid? 20 kobo, right? 20 kobo. Bracket 1 plus, what is the growth rate? G 0.1. 0.1. All over, what is the market value? Market value is, let's convert it. It's 275 kobo. Let's convert it to naira. 2.75. Let's just make this 0.2. 0.2. Are you with me? Yeah, this thing clear like this, right? Please see it too. Plus G 0.1. I really hope this is, yeah, this is X thing because dividend has been paid. So that's that. Let's punch our calculator. 1 0.18, which is K equal to 18%, right? So let's find KD. Are you with me, guys? So this is simple. So let's find KD. So for KD now, based on this question now, you can see that the question said 12% irredeemable bonds. Irredeemable. And I told you that there are about maybe 4 ways. The last class we had about cost of debt. Let me off this thing. About cost of debt, that, and I told you last class that we have several ways to calculate cost of debt. It could be irredeemable and non-traded. It could be irredeemable and traded. It could be redeemable and traded. It could also be convertible debt, right? So in this case, which one do you think this this which one do you think is best to follow, or which of the types of debt do you think this question is talking about? Which one? Let me know. So which one do you think this question, what kind of debt is this question talking about? So in this question, let me just go straight to the point. It is irredeemable and traded, because we have the market value for it. it has a market price, it has a market value, and the question says 12% irredeemable bonds. So what's the formula for calculating irredeemable and traded? It is I interest over market value x int 1 minus t post tax. If you can remember now, if you can remember, irredeemable and non-traded is just KD is equal to interest 1 minus t. So because it's not traded, so there's no market value. But if it is traded, there is market value, which is this case. And if it is redeemable and traded, that is already IRR. And that's why we'll be talking about lower rate plus NPV and all of those things that I've explained before, right? So here is it. So what is the interest? What's the interest? 12%, right? 12% interest. So 12 over 12%, 12 over 100, right? 12 over 100 times 100, right? Exactly. 1 minus, what is t? T is 0.3 over, what is the market value? 80. 80. Can you see that? So punch your calculator. Let's see what we got. See, this is simple. If you have been following the class now, or you've been following the classes we've been having, especially the cost of debt class, this should not be an issue, right? It's even very simple. Even if you've not watched it before, I mean, this is very simple. Simple mathematics. All right. So we have 3 times 12 over 80. So we have KD 0.105, which is the same thing as, just multiply by 100. It's same thing as 10.5%. Can you see that now? So we have our cost of debt and cost of equity done. So right now we've gotten our cost of debt and cost of equity, right? So what else do we need to find in order to get WACC? Look at the formula here. So we need to find our equity value and our debt value, since we've gotten cost of debt and cost of equity, right? That is the reason, or that is the importance of writing out your formula to guide you, right? So now, how do we get our equity value or equity market value or total value of equity? Anyone? So look at the balance sheet, and I told you that do not use the information you are given in the balance sheet because it is an historical value or it's the book value. So don't use the book value, use the current market value, right? But it's also going to help us, of course. So we have the authorized share capital, we have the issue share capital, the one that was actually issued out. All right, so to be 100 kobo, so 100 kobo per share, right? So 100 kobo per share, and we have 8 million naira, that is the value, right? So 100 kobo, 100 kobo per share, 80, is it 8 million? Is 8 million? 8 million. So 100 kobo is similar to 1 naira, right? The same thing, right? So if you see it, it's just telling you that we actually have 8 million shares, because 8 million shares times 1 naira is still 8 million naira, which we already have there. And 100 kobo is just 1 naira. It's simple, right? So we have the total number, so equity. So so to get equity, equity will be what? What will be the formula to get equity? It will be number of shares times market price per share. So what is the total number of shares? Total number of shares is 8 million. And I know we know how we got the 8 million naira, 8 million shares times what is the market price per share? That is 2.75. You know how we got 2.75? We have 275 kobo, right? Divided by 100. 2.75. Why do we divide by 100? 100 kobo equal to 1 naira. All these are mathematics. I don't want to be doing all of that, right? So if you calculate it, we have calculator 8 million times 2.75. So we have 22 million naira. So this is it for equity value. What about for debt? Don't forget for debt are quoted. They are usually quoted in bundles, right? In this situation now they said um bonds are priced at 80 naira, right? That means the par value will be 100, and the fact that they price this one at 80 naira, that means it's priced at discount because it's less than the par value, which is 100. And had it been it was priced maybe 150, for example, that means it's priced at premium. Similarly to the ordinary shares that we have, which is 275. If we are giving the market value, for example, so that is that. So is just similar. So here now we have the debt priced at 80 naira, which means it is priced at discount, right? And if it's above 100 naira, it is at premium. 100 naira is at par. Bonds, debentures, they are usually quoted in 100 or in 1,000, either 100 or 1,000, depending on the question. So in this particular question, it is actually 100 because the price that we have is at a discount of 80. That means it's going to be 80 per 100 nominal value or par value. You get that? It's similar to the previous question that we did when they said 2 million loan notes is an issue, which are currently quoted at 17 naira per 100 nominal value. So that 17 naira is actually at a discount per 100 nominal value. Do you see that now already? So let's continue. So for debt, so for debts now, so for debt now, what is the book value that we have? The book value that we have for debt is 12% redeemable bonds. We have 4 million naira. 4 million naira, right? Times the quotes, that will be 80 naira per 100 nominal value. What is the answer? 4,000 times 80 over 100, or 80 over 100 times 4,000. That's 3.2 million. That is 3.2 million. That's the debt value. Can you see that now? So we have these two and we have these two. So let's put that in our formula. So WACC is equal to, what is K? K is 18%, bracket. What is E? E is 22 million. Let's just do 22,000. 22 million over 22 million plus T, then plus, what is KD? 10.5. 10.5%. 1 minus, what is the tax rate? What is the tax rate given in the question? 30%. 0.3. I hope you can still see. Then debt, what's the value of debt? 3,200 over 22,000 plus 3,200. So if we press everything together, we have the answer. Let me punch my calculator. 22,000 plus 3,200. So 15.71, 15.71 plus, this one is 7.35. 7.35. The calculation of this one, 7.35. Then 22,000 plus 3 to 7.35. 0.93333. 0.933. So what is the addition of everything together? The WACC plus 15.71. So we have 16.64%. That is the WACC. So guys, this is the answer. Very simple. And by the way, please, I don't think, I think there is an error here. We wouldn't need to remove tax again since we deducted tax here already. So we just bring this value and bring it here. We shouldn't remove it again. It should be like removing it 2 times. I just noticed that as an error. So let's leave that aside. Look, let's calculate this one again. This cost of debt without the tax. Of course, we deducted tax already. So what is the answer? 3 into 2,000. That'll be 1.333. 1.333. So add it to this 15.71. That would be 17.04. So this will be 17.04. Simple, simple, simple. So that will be all. So I want us to move on to project specific cost of capital or risk adjusted cost of capital. I have 2 questions to solve. I'm going to solve one right now, and I'm going to solve a full ICAN question on that. Are you ready? Let's jump right into it.